Hello, everyone. I'm going to do a Zoom video on writing off accounts receivable. Okay, so what this means is you're a company, and I'm just going to give a brief overview. You have the other videos on it, but you're a company. Someone comes to you and buys $5,000 worth of goods, and then they're like, hey, 2 months from now, I can't pay you. I went bankrupt. Well, what happens with that accounts receivable that you recognized 2 months ago when they purchased the goods? That's what we tackle in this module this week. Now, there are two big methods. One is the direct write-off method, which is what we're going to start off with. You see it down here. The other method is the allowance method, which has a few different ways of doing it. Two of those ways, percentage of credit sales and the aging method, okay, the aging of receivables. We'll get to those when we get to the allowance method. For the direct write-off method, it's real simple. No journal entry is made until a company gets word that they will not receive money from a customer who owes them money. So here we have Batman Company gets word that they will not receive $5,000 from a customer. So a customer owes them money, they have an account balance, $5,000. They tell Batman Company, I cannot pay you. So on the direct write-off method, it says as soon as you get word that you cannot receive money from a customer, that they will not pay for whatever reason, you write off your accounts receivable. So to do that, remember, accounts receivable is an asset. So when it's recognized, it's debited as an asset. When a customer pays it off, it's credited to reduce their balance. When they can't pay, you still have to get rid of the accounts receivable. So we're going to credit accounts receivable, AR, $5,000. The debit for this journal entry goes to this new account called bad debt expense. It's an expense account that is only used when you write off uncollectible accounts receivable, $5,000. And that's it. Now say it's 1 month later and the customer pays. So a month later, the customer, maybe he wins the lottery, he's like, I can pay you now. What you do, since you already wrote off the accounts receivable, is you go up here, you have to reinstate the accounts receivable. Okay. So you're going to debit accounts receivable, 5,000. You're going to credit, you're going to undo the bad debt expense. I just realized I wrote bad debit expense up here. It's bad debt expense. Credit bad debt expense down here. So undo what you originally did. And then part two, recognize it just like you normally would a collection. So you're going to debit cash, 5,000, and you're going to credit accounts receivable, 5,000. This only happens if the customer pays after you write off their account. You only write off their account if you get word that they will not receive, that they will not pay the money. Okay? That's it for this method. Straightforward. You will notice there is no account under the direct write-off method. Never use this account, allowance for doubtful accounts, under the direct write-off method. Okay? That account, allowance for doubtful accounts, it's a contra asset account. So think of accumulated depreciation. That's contra asset. Only used under the allowance method. Okay, so we're not going to have it for the direct write-off method. Keep that in mind. All right, we're going to keep going now. We're going to go to the percentage of credit sales. So now again, this method and this method, percentage of credit sales and aging, they are both part of the allowance method. All right? So the allowance method says, no, you don't wait until you get 100% word confirmation that you're not going to receive an accounts receivable from a customer. This method says, you have to make an estimate of how much you think you will not receive. Okay, remember, accounting and GAAP specifically, generally accepted accounting principles, is all about being conservative. All right, they want you to show less promising figures if that is more likely. Excuse me. So, under the allowance method, and again, there's a few different methods you could use within the allowance method, it all involves making an estimate. So first we're going to look at the percentage of credit sales. This one will help with homework. Batman Company has total credit sales for 2019 of $450,000. It estimates that 10% of those sales are uncollectible. Okay? The allowance for doubtful accounts balance is currently $4,000. So under the allowance method, we will use this account, the allowance for doubtful account, or allowance for doubtful accounts. Again, it's a contra asset account. Under the percentage of credit sales method, what this method says is you take a company's total credit sales for the year, so 450,000, and you multiply the percentage that you estimate is uncollectible. That percentage is normally going to be given to you, okay? In real life, that percentage comes from past historical information. So maybe in 2017 and 2018, the company had 10% of their credit sales not paid. So that's where they come up with that number. For our purposes, you will be given the percentage. All right, so to estimate how much is uncollectible, take the total credit sales, multiply it by the percentage, you're going to get 45,000 in this case. Under the percentage of credit sales method, we do not care what the balance is in allowance for doubtful accounts. Do not care about the balance. Okay, I will make a T account for it because I think they're helpful, even if it's overkill for you at this point. So allowance for doubtful accounts. Okay. So this account, when it increases, it gets credited. Okay, it's a contra asset, so the opposite happens to it. So what this problem said is this account has a $4,000 balance before we even begin. Okay. Now for 2019, credit sales are $450,000. Since we're using the percentage of credit sales method, we multiply that by 10%. So for 2019, we estimate $45,000 will not be collected. Under the allowance method, the journal entry, when you estimate what's not collected, is a debit to bad debt expense. So that didn't change for whatever you estimated, 45,000 in this case. And we're going to credit allowance for doubtful accounts. All right, I'll just add it over, 45,000. This is the journal entry. Note, we do not care that it had a balance of $4,000, not for this specific percentage of credit sales method. So we're going to go ahead, we're going to update our account, 5,000. So now, allowance for doubtful accounts has a balance of 49,000. Now, say a customer, this isn't tied into a specific customer. Say it's 1 month later, Batman Co. gets word that a customer with a $5,000 account balance will not pay. The journal entry for this is kind of already started. Since we're using the allowance method, we already made an estimate of how much won't be paid right here. We will not recognize bad debt expense again. We already recognize an estimation of bad debt expense. So when customers definitely can't pay under this method, we actually reduce the allowance for doubtful accounts for that amount. And then we officially write off accounts receivable. So accounts receivable is not touched until it is actually written off, until a customer says, I cannot pay you. But here's the difference. When they say I cannot pay, you debit allowance for doubtful accounts rather than bad debt expense here under the direct write-off method. And then we would go ahead, we would reduce this T chart, and now the account has a $44,000 balance. Okay? If, let's continue this, let's say it's 1 month later, that customer sends in a check for the $5,000, so they actually pay. A little different procedure than on the direct write-off method. So you wrote off their account, accounts receivable, we credit it here. Under this method, what you would first do is reverse this. So we're going to debit accounts receivable, get it back on the books, and we're going to credit allowance for, I'm going to abbreviate this, doubtful accounts. Then collect it like you normally do. Debit cash, credit, accounts receivable, 5,000. Okay. And you would update the T charts and everything like that. Okay. This is the main part, though. This top part. Next, we're going to move on to the aging method. So what the aging method says, oh, what did I do? I don't know what I did. All right, ignore that stuff. There we go. That, ignore that. All right. The aging method says that, hey, it's another method under the allowance method, but it says don't go by the percentage of credit sales. It says that's less reliable. What it recommends is that, hey, if you have debt that people owe you that's 90 days outstanding, there's a higher chance you're not going to receive that money compared to 30 days outstanding. So what it does is it says break out your accounts receivable balance into how overdue it is and assign a percentage, a chance that you won't collect it to each bracket. So in this case, what these mean, this company has $10,000 accounts receivable that's current. It just happened. The company estimates 5% of this $10,000 won't be collected. Then the company has $15,000 of accounts receivable that is 1 to 30 days overdue. They estimate that has 10% chance of not being collected. Then they have 7,500 that's 31 to 60 days overdue. They estimate a 20% chance that won't be collected, so on and so forth. Okay, you could go on for a year in days broken up, 2 years. I stop. I just put greater than 90 to make this real quick. Okay. So here's how we'll tackle this method. We're still going to assume allowance for doubtful accounts has a $4,000 balance. Okay. So under the aging method, what it says is get a total uncollectible figure. In dollars. So to do that, we're going to take each accounts receivable balance from each period multiplied by its respective percentage. Multiplied across. Then total estimated uncollectible. We're going to add all those together. So equals the sum. You could do this however you want math-wise. All these added together. So we estimate that $6,100 is uncollectible. Under this method, this is big, this is very important. The figure we just calculated already includes this balance. So what this says is that in total, allowance for doubtful accounts should have a balance of $6,100. If it already has a balance of $4,000, how much more do we need to credit it by? The answer is the difference. So if it needs to have a balance of $6,100, it already has a balance of $4,000, we need to credit it $2,100. So the journal entry is the same as the percentage of credit sales. We're going to debit bad debt expense. We're going to credit allowance for doubtful accounts, abbreviated. But we're only going to credit it for how much we need to bring it to its balance that we need, $6,100. Okay? So I'm going to add that to the T-chart. When you add it together, you get the proper amount. All the other journal entries are the same now going forward. So if a customer says, I can't pay $5,000, same exact entry under the aging method that we did in the percentage of credit sales. Same journals. If a month later that customer comes back and says, I can pay, same entry that we did down here. So there's nothing new. I won't repeat it to save time. The big difference is under this method, when you calculate total estimated uncollectible accounts, it's a running figure. It continuously updates, okay? So it says $6,100 is what we think we will not collect. We've already accounted for $4,000. So we only need to account for the difference. That's under the aging method. The percentage of credit sales, since it is based off of 1 year in time, credit sales, it does not take into account the existing balance and allowance for doubtful accounts. Okay? So keep that in mind. Please, please, please keep that in mind when you're doing the homework. All right? I'm going to end this now because it's a longer video. Hopefully it helps. Message me your questions.